We've got to talk about this bond market. We went through it with Lisa. 2016, when we were at these levels, we were talking about a global recession. What are we doing now?
Yeah, it's really a conundrum, I think, for the Fed, because as they try to signal that they're tightening policy, all we get is a flatter yield curve and lower long-term rates. And I think that tells you that the market's view is that inflation isn't going to last a long time and that growth will decelerate next year, and that we have enough demand at the long end of the curve to prevent yields from rising very much. So it places a lot of pressure on the Fed. How high can they go in terms of rate hikes and not invert the yield curve? And that's going to be probably the biggest problem they face over the next 12 months.
Kathy, what would you say to the argument that the bond market, I don't want to say is wrong, but is distorted by quantitative easing, by the savings glut, by what's going on overseas?
Yeah, I don't think it's distorted, but those are certainly factual. That's factual evidence that can contribute to low bond yields. And clearly, if there's one surprise that the Fed could pull off, it would be quantitative tightening, right? If they really wanted to see long-term rates move up, they could start selling bonds and reducing the size of the balance sheet. I don't think that's going to happen anytime soon, but that would certainly be one way to do it. But I think the collective wisdom of the market here is that, yeah, we have a lot of factors holding down long-term rates. The global savings glut isn't going to go away tomorrow. Aging populations aren't going to disappear tomorrow. And that continues to make demand at the long end of the curve for, 20, 30-year paper very, very strong. And that's the reality in the bond market. I think that's reflected in this flattening curve.
And that's why you call a terminal rate of 1.75%, Kathy. Talk to us, therefore, about looking out further along the risk spectrum. How much are we going to see an outperformance of potentially high yield if you are going to see such tamed long end in government?
Yeah, high yield and investment grade have been doing great. Again, credit has good, strong fundamentals here. The problem is, of course, the yield, right? So you're not getting much spread over Treasuries to take that risk. But it's hard to see in this environment that credit won't continue to outperform Treasuries in 2022. It's really just a question of how much risk you want to take in terms of moving into the lower credits for the event that we get some sort of an accident in the market, or certainly if we were to get an inverted yield curve, that would be a negative signal. So it's all good except the yield in the credit world, but I do think it will outperform in 2022.
Kathy, just finally, something Lisa and I talked about in the last hour. What would a hawkish surprise look like tomorrow at the Federal Reserve? Can you just give us a little bit more detail on that, on how they could surprise hawkishly at the FOMC?
Yeah, I think, they could raise that terminal rate. I'm not sure that the result would be a sell-off at the long end. It might actually be a rally at the long end if they did that, but they could move up that terminal rate. Or again, quantitative tightening. They could start announcing roll-off sooner rather than later. And I think that would be a surprise to the market.